Welcome to the income taxes for tribal producers. And I'm Ruby Ward at Utah State University, but we also have other people here with us, and we're really viewing this as a workshop with back and forth. And so I have a colleagues on here. JC Hobbs is here from Oklahoma State University, Trent Tegerstrom from University of Arizona, and Vicki Hebb is a tribal producer, and she works with the University of Nevada, Reno. And then we also have Stacy M, who is a tribal producer that works with the University of Nevada, Reno. And we're part of a team of a larger projects. And so they will go ahead, and you may see other people chiming in, but if you have questions, feel free to ask them. We really want this to be a back and forth. And then in the next hour, starting at noon for my time, but an hour from now for whatever your time zone is, JC Hobbs will talk about weather-related sales of livestock. But before we did that, we really wanted to kind of just go over some of the basics of how income taxes works for farmers and ranchers. And so the US tax code has specific attributes for farmers, and there's various definitions for what a farmer is, but it's just the reason why we want to talk about tax issues for farmers and ranchers is that there's a lot of special tax provisions that just happen because for farmers and ranchers. And another thing that to just kind of go over is this program is educational. The tax code is really complex. There's a lot of nuances to a situation that, and just kind of really subtleties in your individual situation that could really completely change some of these things. So this isn't to make you be able to prepare your own tax returns or know everything about taxes, but is our goal here is that sometimes your tax preparer is making decisions for you and making decisions, and it's hard for you to kind of know what's going on there and what the results are. And so hopefully with a presentation like this, it can make you more informed and allow you to have a lot better conversations with your tax preparer. And so this is just going to go over some of the basics. So this is just our disclaimer that this is for educational purposes only. It's not it's not for the purpose of avoiding tax-related penalties, promoting, marketing, or recommending another party or any tax-related matters herein. So that's just our fine print that's there, but really this is just an educational program. So getting into the actual issues, there can be advantages to filing your tax return. You may be able to take the earned income credit or a child tax credit. You may get money back above what you pay in taxes because of that. You may also use your tax return to prove you have income to get financing. And tax returns are needed for some of the USDA programs, including like farm service agencies, the loan programs that they have. You need your tax returns for that. And so the IRS has a form that you file for your personal income taxes known as the 1040. And the 1040 is kind of your basic one. And that everybody pretty much files a 1040 now. And it's kind of like the synopsis, which is probably not a good word, but it just summarizes everything. It's just the summary of all the different tax information that's contained in attached forms and schedules and everything else. But the front of that is the 1040, and we'll show you what that looks like. And then with the 1040 are 6 supporting schedules. And this is where, and when you start to get the supporting documents, that's where you start to have more of your actual details of what's going on. And Schedule 1 is a really one with a lot of stuff on, because that's going to capture information from several of these things. So if you have a business, that's going to be on Schedule C, and that's going to capture it. Capital gains and losses, or if you've sold like some of your equipment and you had a gain on that. 4797 is where your cull cattle sales would show up. And then real estate rent, cash rent is going to be on Schedule E. But the big one that we're really looking at is Schedule F, farm income. For this presentation, that's going to have all your farming and ranching income. Well, most of it, but like your cull cows will be on 4797. And then self-employment tax, and we'll go over that a little bit later too. But so a lot of the details are going to be in Schedule 1. And then, and I'll show you what, we'll get into kind of what these look like and stuff, but I thought it was just kind of good to kind of go over some of the forms right now. So there we go. So why is Schedule F special? And why, and this also can be think about like, why is farm special? But you can file it on a cash basis, and there's places for farm categories. So cash basis is like most of what we do. We don't keep track of what year and our inventory and changes and stuff. When we have an expense, we buy some hay, we can deduct that cost of the hay. Where if we weren't filing on a cash basis, we might have to keep track of the cost of that hay and not deducted on our tax return until we've actually fed the hay and sold the cows. But for farming, we can file it on a cash basis. So when you make expense, you have expenses, you buy things, you can put them on your tax return. When you sell your cattle, the proceeds from that will go on that tax return. And then it has the categories for the farm income and expenses. And I left out, I'm just gonna, so here's what the form looks like. And so you can see that you have your sales of livestock here, other sales of products you raised. So there's a lot of this stuff here that it looks like, you know, farming type income. And then the bottom part of it is where you do your expenses. So that's what your Schedule F is looking like. And so then you want to meet the need. And then when you're thinking of that, and we're going through and we're going to look in more detail at Schedule F, you really want to keep in mind like what records you're going to need to keep to be able to take to your tax preparer so they can fill this out. So don't just think about, you know, kind of what it looks like, but also what type of information will I need to keep track of that I can take to my tax preparer. And so your record keeping system that supports this needs to help you, it needs to help your tax preparer, the lender, other purposes and stuff. So you, just because you may need to keep more records and want to keep more records than just what you would do for tax purposes. You may want to know production type records and stuff. But really for this purposes, when you're thinking about going to a tax preparer, think about what are the records that you need to keep and kind of keep that in the back of your mind as we go through some of this. So like I said, cash basis, income is cash or checks. And so we can't hold on to those checks. So that means that if Vicki came to me because I sold her some hay in December and she brought me that check over in December, I can't just kind of forget that she brought me that check over in December and, you know, just put it in my cupboard and keep it there until January so I don't have to declare it. As soon as I got that check from her, I really need to go ahead and deposit it and keep it and count that in my income. And then any expenses we paid for, you can include those when you buy them. So special cases are cattle purchased for resale. And this is one of the exceptions that we have is if I buy some calves that I want to feed and then resell, I actually have to wait and not include the cost of that until the year that I sell the calves. So if I bought those calves in like November and I'm going to sell them the next spring, I can't include them in this year's income. I've got to wait until the next year when I sell them. And so, because the ones that you're buying for resale, you want to match up the cost of what you bought the animal for with when you sell it so that they work there together. So they both need to be there in the same year. Where other types of things, as long as we sold it, we count it. If we've paid cash for the expenses, we count that. And then your profit is just your income minus your expenses. And you'll also need to put in your name, your social security number. There's places for the income, expenses, net profit. And so let me show you what this form looks like. So as you can see up here, it's the Schedule F, profit or loss from farming. This is the 2019 return or form, but it really hasn't changed. And then, so you've got a name up here, the name of the proprietor. So that's whoever the owner is. And you'll see there's only one line for this. And so if you have a husband and wife, it's really going to go, it's either going to be split. And so two Schedule Fs will be filled out for both the husband and the wife, or it's all going to go under one person's social security number. But really, it's just the name of the proprietor. So a single owner with their social security number, the principal crop or activity, in this case, it's beef and grain, and there's a code that your accountant will know what it is. And then you check this box, cash method or accrual. And so 99.9%, I would assume, of returns that are filling out Schedule F are done on a cash basis. And so we've already kind of talked about what that cash basis is. It asks, did you materially participate? So that means, were you actively involved? Were you making decisions? Were you actively working on your farm or ranch? And then Form 1099, we're not going to get into it today, but it's sometimes if you buy stuff from certain people, you may have to fill out 1099s. You may get 1099s from others. And then, so then we get down here to really kind of starting to get into the meat of it, is this farm income. So you can see we have spots for the sale of livestock and other resale items. And then we have this line 1B, that's the cost or other basis of livestock or items reported on line 1A. So this is where I said the only departure from that cash basis is right here, where we're going to take the value of selling calves that we bought to resell here, and then minus the cost of what it took to purchase them. And then only the difference goes over here as part of our income. So this is one place where we can't write those calves off when we buy them. We have to wait until we sell them, and then we match that up. And then sales of livestock, produce, grains, anything that you raise is all here on line 2. So for most operations, line 2 here is going to be where the most, you're going to see the biggest numbers, and you see that here in this example. Cooperative distributions. And so if you belong to a cooperative and then they send you at the end of the year a 1099 -PATR, that's for patronage dividends. But if you get some of those patronage dividends back, that's going to go on here. There may be provisions and times where they're not all taxable, but normally they are. And then agriculture program payments. And so various programs that we have, the disaster relief program payments, that because of the drought that you might be getting, any kind of program payments that you have, those are going to go here on line 4. And again, there might be provisions where the full amount is not taxable. So you need to have this full amount on here that matches up with the 1099 you receive on that. But then only the taxable portion would go over here on line B and get added into our income. Some other things, crop insurance proceeds, so, and federal crop disaster payments right down here on line 6. If custom hire, so if custom hire is when you get paid to like maybe plow a neighbor's field or bale their hay. And if you're in the process of doing that, so like we have in the Midwest, a lot of people that's just full-time, they go through and harvest different farms' grains. That's not a Schedule F activity. That's not a farming business. That's a normal business because you're in the business of harvesting grain or something else. But if you, as part of your farming operation, we have the equipment and stuff, we're in the business of farming, but we might do a little bit of this on the side. So we plow the neighbor's field. There's a neighbor that we ended up spraying some of their crops. We baled somebody's hay. We hauled a little bit of grain or something for somebody, and they paid us for it. That's going to go under here under custom hire, machine work. And then anything else that's in there, and then you add all that up, and that is your gross income. So this is our income, money that's flowed into our operation from our farming and ranching activities. And then on the bottom half of it, we have our farm expenses. And so this is the money that we've paid for all of these different expenses. And so you can see like chemicals, conservation expenses. If you hired somebody else to do some of your work, harvest your grain, bale your hay, then the cost of that would be included here as custom hire. Depreciation is when you have your equipment that you're going to use it over several years. So depreciation is our method of taking a portion of that and putting it on each year's tax return. But there are some provisions like Section 179 that can allow us to maybe accelerate that or do it a little bit faster. So we have depreciation, feed purchases, fertilizer, freight and trucking, gas, insurance that were other than, it's not your health insurance, but it's your like property insurance, your casualty insurance, your car insurance, things like that. Interest on your loan, not the principal portion, that's paying back what you originally borrowed, but any interest is the cost of having that loan. And so that can be deducted as an expense. And so most of your mortgage payments are going to be composed of two portions, part interest and part principal. So you split those out and then just the interest portion gets here. Labor that you've hired. So you can really kind of just see that these all are matching up with expenses that you would have on the farm. And so if you're thinking about your record keeping system, you want to think about splitting these out amongst some of these different categories, and then you take that to your tax preparer and they can put them here in on the form. And then I
just wanted to make sure that we do our disclaimer. We're not trying to overwhelm everyone with all of these line items. We want you to be aware of them on these forms. It can be overwhelming, and as a producer, you know, these are all the things that we do in the record keeping that is so vitally important. But you do have, you know, resources where this stuff goes to, and they know where to put this. We just want you to know what filing these taxes entails, not to overwhelm.
And not every operation is going to have every single type of expense. So split your expenses out the way that it makes sense for you to split your expenses out. But you really want to kind of keep track of your receipts and your expenses for all of these things. Keep them in a separate box and stuff. And then so if there is a question and we need to split something else out, but it's not the end of the world if some of this stuff isn't on the, you know what I mean, not split out the way that they did here.
But you can look at this. Yeah, you could look at this form and say, okay, I need to track my supplies. I need to do this. So you can start to just to help you ahead of time throughout the year so it doesn't overwhelm you at the end. So it serves as a good guide. Yeah.
Yep. So it's going to add your expenses up here, and then it's going to deduct these from the income that we had on the top half of the page. And then the net difference here is on line 34. And that's our net farm profit or loss. And that's the number that's going to go back over onto our Schedule 1. And so, like I said before, you know, we have the 1040, then we have all these different schedules are attached. So this is where everything needs to end up, is on the 1040. That's summarizing everything. But we have kind of layers on our tax return. So we filled out the Schedule F, and then that's going to go on here to Schedule 1, and then that's going to get put back onto the 1040. And so here's what Schedule 1 looks like. And so you can see here additional income. So 4797, that's your cattle sales, is going to be here. But then here on line 6, it says farm income attached Schedule F. So that net amount from the bottom of your Schedule F goes here, is added with other sources of income, and then that's going to go over on the 1040. And then the bottom half of Schedule 1, these are just different adjustments that you might have. And I don't want to get too deep into the taxes, but just to kind of give you a general feel for where your farm income's kind of flowing through these different returns or different schedules. And so then here on the 1040, this is the front half of it. It's just a front and back. This is half the return. And you can see down here, there's a Schedule 1. And so line 9, and so you take that net of adding up all those different sources of income and you add that, you put that here. So that's how the Schedule 1 then dumps in here to the 1040. And it gets added to, up here is any W-2. So if you worked for somebody else and your wages, that would go up here on line 1. And then just your income from your farm or some other businesses gets added to that. So that's there. And then the back part of the return is just figuring out how much tax you owe. Do you have credits here? And so we said, like, kind of some of the advantages of filing your tax return is to get like that child tax credit. And so portions of this can actually be refunded to you above even what you've paid in taxes. So you get your total tax after making the credits. And then you look at if you had any withholdings, and you can come down and see, in this case, they had a refund. So this is what the tax return kind of looks like. Any questions on this? I'm going to go into some other issues to be aware of, but I just wanted to see if you have questions before we get going on there. And if you have questions, feel free to just stop us. Again, this wasn't meant to say, oh, I'm going to go prepare my own taxes now. But hopefully you can see as you get the tax, because sometimes we pay somebody, we pay them a lot of money to prepare our taxes for us. they say, oh yeah, we have it, here's your tax return. But a lot of times we have no idea of how to really kind of look at that. But you can, if you know where to go, you can look at that line. You can say, okay, my farm income, and you can come to your front of your 1040, look for this line here, and then say, okay, let me look at Schedule 1, find your Schedule 1, and then you can see kind of that, and then find that Schedule F, and you can kind of see how the tax preparers put that information in. And so sometimes it's nice to just not be able to have it be a big black box, but you can actually kind of look through and see where some of that information is on your tax return. And then other tax issues. So Worldtax.org is a website that we created to really just look at farm and ranch federal tax educational materials. And so these materials are drawn from the website. The committee that's behind the website is the National Farm Income Tax Extension Committee. And I'm a member, and JC's a member, and so is Trent. And so we meet with the IRS each year to edit the Farmer's Tax Guide, because originally this was an extension publication. And so there's been this relationship between IRS, but we felt like we couldn't make changes in the Farmer's Tax Guide because sometimes they're limited by language in the code, in our actual laws and things like that. So we wanted to have more control and have a place where we could have information that was more useful in a way that and more control over it. And so we created worldtax.org. And so this is what the website looks like. We put up a page here to just kind of put information on that was flowing in on COVID related tax resources. And then if you look over here, there's tax topics. And if you click on the tax topics, it'll come over to this. And then there's these are just short articles on various topics. The CFAP payments, if you receive CFAP payments, the taxability of those, we put something together. Some initial information on the American Rescue Plan and the debt relief, some of the tax stuff related to that. So anyway, there's just different topics here. Weather-related sales of livestock is what JC's going to go over. That's going to be here. Self-employment tax I'm going to go over. And then it goes down beyond what this page is. That's where you can go for more information. And so I'm going to go over into self-employment tax. So why is it important? It's a survivor benefit, which means that if a spouse dies, then the survivor there's some benefits there potentially from your self-employment tax. It's a retirement benefit, so your Social Security after you retire. And then there's also a disability benefit. So if you've paid in with Social Security, and there's some type of tragic accident or something else that you can no longer work, there are some disability benefits that would kick in until you retire. So these are the benefits of why it's important to pay your self-employment tax. And a lot of times with tax preparers and people in general, we want to minimize our taxes. So sometimes we do things so that we don't have self-employment tax, but it may be that we want to actually have enough to kind of have some of these benefits or keeping those at least in the back of our mind. And so what is it, self-employment tax? So if you worked for somebody else and they paid you salary and wages, then before you get your paycheck, they're going to deduct 7.65% of what you earned for FICA and Medicare. And then you would get the net out of that. And there might be other things they withhold from that, but they're going to take out that 7.65%. Then they have to match it with the same amount. And then they send both sides in to the federal government. And
Ruby, do you want to explain what the FICA is? So, for the acronym, so they kind of get a sense.
So I think people use the acronym more than they use the actual words, but it's what you're like, if you get your Social Security, it's what you're paying into that would end up having like your Social Security benefits when you retire. Those are going to come from that FICA portion. That's what it's used for mainly. And then the Medicare is used for some of those disability type benefits, the medical, and issues and stuff. So that's why it's breaking it into the two sides. We used to always just call it the 7.65% because we not pay too much attention that there was two little pieces, FICA and Medicare. But the reason I split them out is because above a certain amount, and I can't, it's about around 120,000, but I can't remember exactly what it is for 2020 or 2021, then they'll take all of this out up until that amount. And then if you make more than that, they'll actually not take out the FICA, but they'll just take out the Medicare portion. And the Medicare portion, I can't remember. Do you remember, JC? Isn't it around like 3%, 2.3% or something like that?
The Medicare portion is 2.9, and the FICA, which is the Federal Income or Federal Insurance Contributions Act, it's the 7.65 times 2 or 15. Well, that portion is
Yeah.
let's see,
So
whatever the difference is. So
yeah. So anyway, you come in here, and so when you're self-employed, like I said, that so, or when you're working for somebody else, they take the 7.65% out of your paycheck, they pay the other half, and they send in 15.3% to the federal government. But when you're working for yourself, you're the employee and the employer, and so you, lucky you, get to pay both sides on any of your self-employed income and send both halves into the federal government. So that totals up to 15.3%. And so 15.3% of what you make as a self-employed individual is your self-employment tax.
now remember, they do get to take off half of that off of the 1040 as an adjustment. So they don't pay any tax on that portion, at half, but it's there.
Yeah, so you get, so it, yes, so it'll work to lower your income tax a little bit more, but it is, so the reason I bring it up is because often for our small producers that are self-employed, the self-employment tax can be higher than the income tax. And because one of the big things is that we pay it on every dollar of profit. Now, we don't need to pay it if it's less than 400. So it's not, but say you had $1,000 of profit that's self-employed, you would owe 15% of that, or $150 in self-employment tax. But if your only income was $1,000, you wouldn't be paying any income tax. And so sometimes when we have these really small new businesses and people that are just starting up, it really hits them hard that first year because they're not expecting it. Because with our standard deduction and other things, we don't pay income tax on every dollar. And so here is an example of what I was going over. So John and Lucy Farmer are married and have 2 children. And this was from a few years ago, but it's about the same now as it was then. I just have not refigured the numbers. So their net profit was $45,000. That was, so we just want a simple example. They don't have any other source of income. And based upon that, their income tax liability was $1,300, but at the time they had the earned income credit and some different things. So basically there was things to kind of counteract the income tax. But the self-employment tax for that same family was almost $7,000. And that's what they ended up paying. Most of what they ended up paying in taxes was the self-employment tax. It wasn't the income tax. And so you can, a family of 4, I haven't done the numbers recently, and with the changes in the child tax credits, the standard deduction and stuff, that might have changed a little bit, but it used to be around $40,000, $40,000 to $45,000, somewhere in between there. That's how much you could make as a family before you started to pay any income tax. Where self-employment tax, if that's all self-employed income, you're paying the self-employment tax on that. So that's why people want to avoid self-employment tax, but there is a farm optional method that allows the farmer to acquire quarters of coverage when their profits are low. So you can actually choose to pay in some self-employment tax in years when you don't have enough income that it's going to pay the minimum amount to keep you current. Quarters of coverage is what's used to determine if you're current on that. So if you have those disability payments or other things to say that I'm current, and so I have enough quarters of coverage so that if something happens, then those benefits kick in. And if you don't have enough current quarters of coverage, then, and you have, an event where you get hurt or something, you become disabled, you may not have the disability benefits if you're not current on your quarters of coverage. And so gross farm income less than 7,900, or profits less than 5,700, you can choose to add in this farm optional method. And this is because farming income can go up and down. And so again, it provides you a credit for up to 4 years of coverage. And then the cost of the coverage about a little less than $900. There's no limit to the number of years that a farmer can use this method, but it is available for farmers, and it's something that you might want to consider. And this is one of those things that you may want to know about to bring up with your tax preparer, so that you can have kind of a good conversation about is this something that's right for me or not.
Yes, we run into this quite a bit where the quarters are not covered, and when you get time to transfer the farm over to next generation and or retire on there, it becomes an issue at that time, and you really need to pay attention as you're going through this. So.
And so the other one that I wanted to bring up today is hobby loss rules. And the hobby loss rules are kind of some terminology that we use, but really it's saying if I don't have positive income, but in a farming or ranching situation, there can be years where you have negative income or a loss. And so that negative income could actually show up on, and I'm just going to go back really fast. I didn't think about where to put some of these forms. So if you had negative income or a loss, then here on your Schedule 1, we could actually put a negative amount here if it's a business. And so that might be minus some amount, and then that would get added together with your put on to the 1040. And I thought that I had the front, there it is. Okay. So then here on schedule, where we add in Schedule 1. So this could be a negative amount if you had a loss. And then if you had positive income from a job or something, you would add those two together. And it's actually could be that your adjusted gross income here is less than what your job is, because it actually decreased that because of the loss on your farm. So if it's a business, we can take those losses and we can deduct them here on our form and net those out. But if it's a hobby, you don't get to deduct money you spent on a hobby. You only get to deduct losses from a business. And so when we say hobby loss rules, is what we're really looking at is when we have years that we have negative income or losses, is it a hobby? Is it a loss from a hobby, or is it a loss from a business? And so can we put those losses and declare them on our tax returns? And so like I said, it's to be able to deduct expenses greater than your receipts. And you have to be engaged in business with a profit motive. So the purpose of the business has to be to make money. And then and it's not a hobby if the profits are made 3 out of 5 years. So every 5 years, if 3 out of those 5 years, that income is positive, then it's not a hobby. So if you're in some of these situations, sometimes it's good to kind of remember on that cash basis of accounting, or that we're filing our tax returns, maybe it's good to, do the timing of some of those expenses and stuff, you know what I mean? So that you have some positive income in some of those years. If you don't have positive income in 3 out of 5 years, you still can, you can still deduct the losses as long as you meet these tests. And the IRS won't automatically come in and examine your business, but it allows the IRS, if you don't have positive profit 3 out of 5 years, it allows them to look into it. It doesn't automatically do it, but it allows them to. And if they do look into it, they're going to use these guidelines. And there's actually 9 of the guidelines, and I haven't put them all here. And if you go back to worldtax.org and you get that article, and in fact, Trent or JC, do you want to just grab the link to that article and put it in the chat box? I should have done that ahead of time. So it'll list all of the different ones. And there's the self-employment tax article can also be put in the chat. So some of the guidelines are you carrying this out in a business-like manner? Do you have a separate checking account for the business? Are you keeping track of those receipts and expenses? Are you making plans? Are you doing things like this workshop and other workshops that we do to seek additional knowledge and education so that we can put better plans in place and improve our operation and make money? The expertise of the producer, the time and effort spent So you ought to keep track of, just kind of the time that you're using and putting into this business. And I saw a situation where they just had, every weekend they said went and worked on the farm. And the IRS didn't really like that because they said, well, what are you doing on the farm? Are you playing or are you not? But when they kept track of some of those things, like we plowed here, we planted here, we were doing this and stuff, just having more of that case of this is a serious business that we have. Those are the types of information that they're going to look at. And it's not yes or no's to one of these, questions and stuff, but it's more, these are the different kind of general areas that they're looking for to see what's there.
One other area that they really look closely at, you may not make a profit for 3 out of the 5 years, or you may have an extended period of no profit, but as long as the business, the value of the business is growing, is a great indication that there's a profit motive, even though our income expense records indicate that we are not making a tax profit, but we're growing the business, and consequently the net worth of the business indicates a profit motive.
Yeah, so it's just something so these are just a few things that I think is good to just kind of keep in mind. And there may be some extra records that you want to keep as you're going through here or think about it. Also, there's very little information in IRS publications and different things for individual tribal tax issues, but there are some special unique issues for tribal tax. So one of these is income from individually allotted land that remains in trust. So the General Allotment Act, the Dawes Act of 1887, provided for tribal lands to be allotted to individual Indians in trust for a period of years, after which the lands were to be conveyed to the allottees in fee. And this provision, this sentence in there, free of all charge or encumbrance whatsoever, that was the provision that there was a couple of Supreme Court cases, and one of these was Squire versus Capeman. And this was interpreted from that Supreme Court case to prevent the taxation of income or capital gains derived directly from the allotted land while it remains in trust. And so that's the provision then the Supreme Court case that came back through. So we have that. And then in I believe it was 62, they came back, and this was for crops, but they also said livestock counts too. So livestock and crops. And then these are the revenue rulings. So the IRS put out the revenue rulings in 1956 after the one Supreme Court case. And then also in 1962 when they came back and said livestock counts too. And so if you need the authority from the IRS on that, this is the revenue ruling numbers. And so that's why I wanted to put those in here. But because it's not part of the laws that we passed, like we passed the Jobs Tax Cut and Jobs Act a few years ago, and that became part of our tax code. So there was changes and stuff, and then that can go into the publications like the publication Farmers Tax Guide and other IRS publications and forms and stuff. But because this wasn't part of our tax code with the laws that we passed, the IRS, the way they can only publish things based upon the tax code. And so it's not part of tax code. And so we don't have a lot more details on that. Intertribal Agriculture Council had at one time a draft guide for tribal tax issues for farmers and ranchers. That wasn't quite the name of it, but that I don't believe exists anymore. But this is to my knowledge, this is the IRS revenue rulings on those issues. And that is all that I have. I'm gonna stop share. And so are there any additional questions? And I'm gonna launch a poll while we're doing that. And so in a few minutes, in about 12 minutes, it's going to be on the same connection. So you can get off and come back on if you want, or other people may just join us and stuff. But yeah. JC is going to talk about weather-related sales of livestock, but we'll take a break until noon. But we're here to answer any other questions that you might have.
Ruby, there is one in there from Jim in the chat about, but those exemptions only apply to ag producers on their own allotment, correct?
Yes.
Yeah.
It's individual allotment.
Yeah, individual, not the tribal farm or ranch. It is the individual.